So to focus where the markets are going, we need to know if we're in an uptrend or a downtrend. And like I told you before, an uptrend is when the markets are making higher highs and higher lows. And a downtrend is when the markets are making lower highs and lower lows. So an uptrend is when the markets are making higher highs and higher lows, and a downtrend is when the markets are making lower highs and lower lows. And the consolidation is when the markets are neither moving up or down, just moving sideways. This is a consolidation. And it's not advisable to trade when the market is in this phase. This is a consolidation. It's not advisable to trade when the market is moving like this, when the market is in this phase. So keep your focus more on trending markets moving either up or down and avoid consolidations. So uptrend in an uptrend market, we look out for buys because the market is literally going up. And in a downtrend, we look out for sells because the market is literally going down. So this is an uptrend. On an uptrend, we see higher highs and higher lows. So this is your higher high, and this is your higher high here. So this is your higher low, and this is also your higher low. And these are your break of structure. These are your break of structure. These break of structure are like confirmation that the market is really going up. So if you notice, the market moved up and retraced a little bit and then moved higher, breaking this higher high just to create a new higher high. This is a break of structure because the market has broken this higher high. So retraced again and then broke this higher high again. That's why it caused a break of structure here, just to create a new higher high. So same for the downtrend. Same thing for the downtrend. The market moves in lower highs and lower lows. This is your lower high here. So if you notice, the market moved down, creating a lower low and then a lower high, and then a new lower low, leaving a break of structure behind, meaning it took out this lower low. This caused this break of structure. So same thing again, moved up and broke this lower low. That's why we have this break of structure here and moved lower. So this is a downtrend, or you could say a bearish market. This is the market is going down, and what we should look out for is sells. The market is going down, all we should be thinking is sell, like I've always told you before. Higher high, higher low, uptrend, then lower high, lower low, downtrend. So when the market is in an uptrend, all we should be thinking is buy. All we should look out for is buy because the market is going up. And when the market is in a downtrend, all we should look out for is sell. All we should be thinking is sell. Why? Because the market is really going down. We'll look out for sell positions. So if you notice, the market moved, if you notice here, the market moved up and retraced a little bit and then move higher and retrace a little bit again, creating a higher low, and then moved higher again, creating another higher high. So this is called a break of structure because the market broke this high. The market broke this high right here. So this is called a break of structure because the market broke this high. But the market is not going to keep moving up forever. Like the market is not going to keep moving, making higher highs and higher lows and higher highs and higher lows, keep moving up forever. There's going to be a point when the market is going to start moving down. And when that happens, we're going to see a market shift. Market shift is like a break of structure to the downside, but it's not called a break of structure, it's called a market shift. So this right here is called a market shift because the market is about to shift from bullish to bearish, meaning the market is about to go down. How do we know the market is about to go down? Because there's been a market shift. The market didn't break higher. The market didn't retrace to break higher. This time it broke lower. So this market shift is the reason for, let's say, a downtrend is about to start. So when we see a market shift, this means the market is about to go down. The market is no more going up. The market is about to go down. And then what do we expect? A retracement to the upside. A retracement to the upside, and then the market keeps going down. Why did the market keep going down? This is because there's been a market shift, meaning the market has shifted from here. The market is gonna, from this point, it's gonna start moving down and down, making lower highs and lower lows. So the market has shifted from bullish to bearish because of this market shift. And what we should be looking out for right now is sell. We are no more buying the market. We are selling. We should start selling. Do you understand? All we should be looking out for right now is sell positions. 'Cause like I told you before, if the market is going up, all we should be thinking is buy, buy. We want to buy. We're looking for when to buy. And now the market has started going down. We're no more looking for where to buy. We're looking for sell. We should be selling. That's all we should be doing because the market is really going down. So I'll give you another example from a downtrend, from a bearish market. So the market is not going to keep going down forever. It's going to be a point where the market is going to start going up, and when that happens, we'll see the market shifts. I told you again, a market shift is like a break of structure, but you don't call it a break of structure, you call it a market shift, meaning the market is about to shift. It's been a downtrend, but now the market is about to shift to an uptrend from bearish to bullish. So, what do I expect next? A retracement to the downside, and then just like that, the market starts making higher highs and higher lows. So, the market has shifted from bearish to bullish, from a downtrend to uptrend. So since the market has been in a downtrend, all we had been doing is sell, sell, and sell. But now the market has shifted to an uptrend, has made the market shift, and the market is now making higher highs and higher lows, higher highs and higher lows. All we should be thinking is buy. Do you understand? All we should be thinking is buy because the market is no more selling. We should not sell. We should be buying now because the market is going up. So in an uptrend, all we should be thinking is buy, and in a downtrend, all we should be thinking is sell. When we're in an uptrend, all we should be thinking is buy. when we're in a downtrend, all we should be thinking is sell. So we're in an uptrend, we should be thinking buy, and we're in a downtrend, we should be thinking sell. So this should stick in your memory. This is what you should always know. When we're in an uptrend, all you should be thinking is buy, and when we're in a downtrend, all you should be thinking is sell. So another thing you should know about are your time frames. And we have two types of time frames. We have the higher time frame and we have the lower time frame. So the higher time frame is where we view the direction of the markets. The higher time frame is where we view the direction of the markets. And then the lower time frame is where we spot our entries, is where we enter. So the higher time frame is where we view the direction of the market, and the lower time frame is where we find our entries. So the higher time frame is like a zoom out. We're zooming out into we're zooming out to view where the markets are going. And then the lower time frame is like, okay, we've seen where the markets are going, the bigger time frame. Now let's zoom in to take our trade. That's why I wrote this. The high time frame is where we view the direction of the market, and the lower time frame is where we find our entries. So example of higher time frames are like 4 hour, 1 hour. An example of lower time frames are 15 minutes, 5 minutes. 15 minutes or the 5 minutes. So for example, I'll give you an example because these time frames are really important. Why are they very important to us as a trader? I'll give you an example of, okay, let's say you didn't consult the bigger time frame, you just entered the market and you see this. So seeing this, you call it a downtrend. You say, okay, the market is going down, let me sell. After all, he said we should sell when the market is going down and we should buy when the market is going up. Okay, you saw this and you said, let me sell. Okay, stop loss above the recent lower high and take profit to the downside. Then you sold, and what happened? Then the market did this to you. Market goes down, goes up, down, goes up, and then the market took you out. And then you might be wondering, why did the market did this to me? Why did the market take my money? After all, you've seen a downtrend and you're in the right phase. Then why did the market start going up all of a sudden? This is because you didn't consult the bigger time frame. You didn't consult the bigger time frame. Take a look at this. Let's stop here. This is because you didn't consult the bigger time frame. This overall trend here says the market is going up because the market is making higher high and higher low, higher high and higher low, higher high, and so on. So this is the bigger time frame. So if you go into the smaller time frame, this is where you see this choppy movement. All these are just a retracement. This whole place is the retracement. This downward movement is the retracement. That's here. This downward movement is the retracement. So you traded the retracement. That's why you thought it was a downtrend, but no, it was never a downtrend. It's an uptrend, and you just traded the retracement. This is the retracement. This is not the overall trend. The overall trend is going up. The overall trend says the market is going up. If you go over to the bigger time frame, because the bigger time frame is where you get this view of the market saying the market is going up, and then you know when to enter. So higher high, higher low, higher high, higher low, higher high, higher low. So the bigger time frame is saying something like this: higher low, then higher high. This is what the bigger time frame tend to do. So this choppy movement behind are the smaller time frames, and these are the retracement. We don't trade the retracement. These are the retracement. That's this phase. This you saw as a downtrend was not a downtrend. It's a retracement to the downside. Like the market is doing break out, break in, break out, break in, break out, break in, break out. As your higher high, higher low, higher higher. So you just traded this retracement here, which is not a downtrend, which you thought was a downtrend. That's why you lose this trade. Why? Because you didn't follow the trend. The trend is saying buy. The trend is going up. It's bullish. You should buy, not sell. So let's say, okay, we saw the bigger time frame. We saw the bigger time frame that the market is going up. Okay, let's say from here is the smaller time frame. This point we go over to the smaller time frame. This here is a bigger time frame. Then you go over to a smaller time frame. So you saw this movement to the down, okay, and you said, okay, I'll enter when I see a market shift. And this here is your market shift. So this here is your market shift. And when you see this market shift, this means this retracement is over and the market is about to go up. And then this is where you enter a buy position. Then your stop loss below the recent lower low and you take profits and you take profit higher. So what are we expecting now? We're expecting the market to respect its higher highs and higher lows from there. So we just made good profits from this trade. Why? Because we followed the trend. We followed the trend from the bigger time frame. This is the bigger time frame, higher high, higher low, higher high, higher low, higher high, higher low, then higher high. This is what the bigger time frame might do. Higher high. Then that's it. So we just made this profits. Why? Because we followed the trend. So this is actually how the market moves. This is actually how the market moves. I'm just giving you a rough sketch of how the market actually moves. So in my next video, I'll be showing you how they move on the real trend on the market like this. I'll be showing you those higher highs and higher lows and how they and the market shifts and all that, the break of structure. I'll be showing you all of that on this trend in my next video. So that's it for this video, and I'll see you in the next one.